Hey everyone, and welcome to this explainer. Today, we are going to pull back the curtain on the real world of money. Have you ever wondered why a market trader in Lagos suddenly has to double her prices? Or why a crypto investor in Abuja just watches his portfolio value drop completely overnight? We tend to think of money as just the physical cash in our wallets or the digits on our banking apps. But there are massive invisible forces at play here, institutions called central banks, and they literally dictate these everyday financial struggles. Today, we're going to reveal exactly how these invisible strings are pulled. Okay, let's dive into our roadmap for today. We'll be covering the illusion of money, meeting the money referee, inflation and interest rates, the global giants, the CBN and your Naira, and finally, mastering the money game.
Part 1. The illusion of money.
It's probably one of the most relatable everyday frustrations we all share. Why do prices keep rising? Last year, your favorite meal cost one price, and today, it's significantly higher. It's super easy to just blame greedy sellers, right? But the reality is actually a lot deeper than that. The real answer lies in the very nature of money itself. Fundamentally, money is just a system of trust. Think back to the old days before money, when we relied on barter. Bartering was terribly inefficient. You had to find someone who had exactly what you wanted and who also happened to want exactly what you had. It was a total nightmare. A problem economists actually call the double coincidence of wants. Plus, how do you store the value of a goat before it gets old, right? So we invented money. It's a medium of exchange, a store of value, and a unit of account. But here's the big catch. Because money is built entirely on trust, that trust has to be meticulously managed, or the whole shebang collapses. Moving on to part 2, meet the money referee. Now, what's really interesting here is looking at the financial system like a massive football league. Your normal commercial banks, the ones that serve you and me, take our deposits and give out personal loans, they are the playing clubs. The central bank? They're the referee. They don't serve you directly. They serve the entire economy. They regulate those commercial banks and they literally make the rules of the game. So what exactly is on the referee's to-do list? Basically 5 huge responsibilities. First, they control the money supply, meaning how much money actually exists in the economy. Second, they set interest rates, which is basically the cost of borrowing that money. Third, they control inflation to protect the value of your hard-earned cash. Fourth, they regulate those commercial banks to make sure they don't just collapse and take your savings down with them. And fifth, they step in as the ultimate stabilizer during an economic crisis, injecting money to keep the whole system breathing. They are the ultimate warehouse and controller of a country's money flow. All right, part 3, inflation and interest rates. Let's bring this down to earth with a real-life scenario so we can see how high-level policy becomes your daily reality. Imagine a trader in a Lagos market raising the price of her tomatoes. Her customers are obviously furious, but why did she actually raise them? Let's trace the steps. A distant policy shift causes fuel prices to jump. That makes the transport fare rise. That causes the truck delivering the food to charge more. And boom, the market tomato price has to go up. It beautifully illustrates how distant macroeconomic policies create a literal domino effect right down to your grocery list. And the nasty result of all those rising prices is inflation. Let's put that into perspective. Imagine you have 100,000 Naira sitting in a safe today. If inflation is running at 15%, by next year, the real purchasing power of that money has secretly dropped to 85,000 Naira. You've still got the exact same physical notes in the safe, but 15,000 Naira of actual value has just vanished into thin air. Inflation literally silently steals your purchasing power. To fight this silent thief, central banks grab their biggest weapon, interest rates. I want you to think of interest rates exactly like a giant volume control knob on a speaker. When inflation is too loud, meaning prices are rising way too fast, the central bank turns the interest rate knob up. This makes borrowing money more expensive, which naturally slows down spending and cools off the economy. On the flip side, if the economy is sluggish and slow, they turn that knob down, making loans cheaper to encourage businesses to borrow, expand, and speed things right back up. Section 4. The global giants. And this brilliantly illustrates the hierarchy of global finance. We've got 3 major players to look at: the Federal Reserve in the US, the European Central Bank, and the Central Bank of Nigeria. Notice the huge differences in their reach. The Fed and the CBN each control the currency for one country, while the ECB controls it for multiple countries. But look at the influence. The CBN is totally vital regionally, but the Fed's influence is just off the charts worldwide. Let's dig into why that is. So, why is the Federal Reserve so incredibly powerful? It's simple. The US dollar is the world's reserve currency. Most global trade, including massive commodities like oil, is priced in dollars. So when the Fed turns their interest rate volume knob up, making the dollar stronger, the entire planet feels the shockwave. Investors immediately flock to the US for better returns, which can instantly suck capital out of and weaken currencies in emerging markets all over the globe. Now, the European Central Bank, they face a completely different, totally unique headache. They have to set one single interest rate for a bunch of very different economies. Imagine the tension there. You might have a rapidly growing economy like Germany that desperately needs higher interest rates to cool down inflation, while at the exact same time, a struggling economy like Greece desperately needs lower interest rates to spark some growth. The ECB has to constantly perform this insanely difficult balancing act. Which brings us to part 5, the CBN and your Naira. Let's zoom back into Nigeria. The CBN is fighting a daily battle on 4 distinct fronts to try and stabilize the Naira. First, oil dependency. When global oil prices drop, the inflow of dollars drops and the Naira weakens. Second, massive import dependence. Relying so heavily on foreign fuel, machinery, and food creates this relentless, never-ending demand for dollars. Third, they have to carefully manage foreign reserves to defend the currency. And finally, they're constantly battling local inflation pressure. It's a tough, tough environment to stabilize. And their ultimate weapon in this fight is the MPR, or monetary policy rate. Whenever you hear on the news that the CBN has adjusted monetary policy, you need to pay attention. The MPR is the base rate. When the CBN raises it, it means your commercial bank is absolutely going to raise its rates too. Suddenly, that loan you need to expand your business or the debt you took on for school fees gets much more expensive. It's not just some abstract, boring policy. It directly hits your wallet. Finally, part 6, mastering the money game. First, you've got to see the global domino effect for what it is. Take our Abuja crypto investor from the beginning, who thinks he's operating completely outside the traditional banking system. Let's trace the timeline. Month 1, the US Fed raises rates. Month 2, global investors seek safe, higher returns and move their capital into the US dollar. Month 3, as capital leaves emerging markets, the Naira weakens. Month 4, global risk appetite drops and his decentralized crypto investments in Abuja plummet. His digital assets are still heavily anchored to centralized global policies. Crazy, right? So, the absolutely crucial point here is, how do you actually protect yourself? Well, you can't control the central banks, but you can definitely adapt. Number 1, understand inflation. Don't let your money sit idle in a place where it's just secretly losing value. Number 2, manage your debt really carefully. Borrowing is incredibly dangerous when interest rates are climbing. Number 3, diversify your income streams so you aren't completely reliant on just one source during a downturn. And lastly, learn financial timing. Understand that economies move in predictable cycles and adapt your strategies to match them. There's this fantastic quote from our sources that I absolutely love, and it's incredibly empowering. You do not need to control the financial system to benefit from it. You only need to understand how it works. So many people really struggle because they just look at rising prices and changing rates with total confusion and panic. But knowledge removes that confusion. When you understand the mechanics, you can anticipate the shifts instead of just blindly reacting to the pain. And honestly, that is the ultimate goal of this explainer. You aren't looking at money blindly anymore. You know about the illusion of trust, the referees pulling the strings, the volume knobs of interest rates, and the global giants shaping the entire board. So I'll leave you with this provocative thought to chew on. Now that you can finally see the invisible structure behind your money, how will you navigate the system? Thanks so much for joining me on this deep dive, and I'll see you on the next explainer.